Hi everybody, this is Tor Storley, and I am back with another video. This is the last video in this bond calculation series that I will be doing, and it's basically a cleanup type of video where I go through the remaining bond functions. Now I might not cover all of them, but I'll cover some of the more important ones. I have this document that says beyond the standard coupon bond. So we're dealing with different type of bond instruments, if you want to call it that. Now, they're not just all long-term, but you might have things like treasury bills and commercial paper, certificates of deposits, and so forth. In this video, we'll cover some of those other available functions in my library that you find in Excel. And as you can see here, I ordered them into some groups. There is a discounted securities group, meaning that instead of paying interest on like a coupon basis every 6 months, what have you, you basically discount the face value and you pay a price, and then when it matures, you get paid back the face value. So it's called discounted, and there's no interest on an ongoing basis. It's like you discount it to a certain price, and therefore when you receive the full amount, that includes interest. So that's what we call discount securities here. There's also a group called maturity interest securities, and you can see a short little description here. Fully invested securities, where you invest a fixed amount and you receive a fixed amount. And then finally, you have accrued interest, where interests are earned since the last coupon date. So some of these are not necessarily instruments themselves, but they compute portion of like interest. How much have you earned since last time? So these are the remaining functions that we haven't covered. All right, so what I want to point out is that after you load the extension and you start working on these formulas or these price of a discounted security formulas like this, one thing you can do to kind of satisfy your curiosity, if you will, is to go to the README file if you want, and I added this section right here. So when you click on that, it will take you through this Microsoft support for Excel financial functions, which is on this page. And I've been through this before in some of my previous videos, but each one of these functions have its equivalent right here that they go through an Excel example. So for example, if we take this price discount right here, the easiest way for me is at least is to, when you're on this web page, you simply go Control F and then just paste in whatever that function is. So let me copy that. Let me paste it in like this. And there it is. So now you found it. So it tells you what it does. And when you click into it, it will give you the details. And this is the same information you're getting when you're inside Excel and you're searching for a function. So let me show you what that means. So when you open Excel like this, right, and you want to find out this function here, so you say equal like this. So here is the function and what it expects. So see this highlighted blue here? So when you click there, it opens up this help on the side here, this page right here. And this is from that web page that we just looked at, this information here. So I have an example and everything. So you can scroll down like this and see all the information about this particular function. But like I said, if you want to satisfy your curiosity, one thing you probably should do is take these input values and put them into that function of the community extension like this. You can see here they describe what it is. And then in the end here, you can see they have some numbers they put in and they tell you how to put it in here. So this is A, column A2, I guess, A2, A3, etc. So when you stick those values into the function and it computes, you can see the result is 9980. Okay, so this information here is the same as you find in the documentation for the support page here. So when you scroll down here, for example, you can see here is the same stuff. And here is the example we just looked at like this. So then it's just a matter of plugging that right into the formula and see if you come up with the same result. So I just want to point that out for you. Okay, so we're going to look at some of these functions. And the first group we're going to look at then is this discount securities. Now, this is something that, is very useful because It deals with US Treasury bills. There's a lot of people investing in stuff like this, and you typically have less than a year maturity. So you can get like 30 days, I don't know if it's 60 days, but 90 days, etc. So you can invest in these Treasury bills, but what they really are is discounted securities, meaning they discount it up front, and then you pay a certain face value at the end when they mature, and that is your return, basically. So if you look at it here, this is that function, the price discount, and this is the formula, and then these are the arguments, so the day you buy it, this matures, etc., etc. And what I've done here is, because it can get a little confusing with these formulas, because you have discounted, and then you have yield, and so forth. So what is the difference? Well, this is where I describe that right here. So it's a very common source of confusion when you invest in this stuff. So here I have some concrete examples. Now also notice that the year I used here is 2028. So therefore that's a leap year, meaning February has 29 days, because you have to go by the actual dates here to get an actual correct answer. And that's not 180 days, it's 182 days like this. One thing you can do is you can use this date difference. This is the actual DuckDB date difference function. You can use that to get the number of days between two dates. And you can see here, you're getting 182. So here, in other words, you're buying a 6-month corporate note. Now, this is not a treasury bill, but this is a note. You are paying this price today, and then you're going to receive 100 on July 1st in 182 days. Therefore, your profit should be this. Now, when you calculate this discounted price, the important thing here is, and I specify that in colors here, if you're going to do the discounted rate of 550 here, the formula is take the face value of 100 minus the price you're paying, this, divided on the face value, which is 100. So that's this one. And then you use 360, because that's what they normally use for these calculations. And then you divide on the number of days that's outstanding. In our case, it's 182. So that's this one. And then you end up with the discounted rate is 550. You're dividing on the face value. And that's the big difference between the investment yield and the discounted yield. Okay, as it's called. Now, so what is the difference? Well, notice here, you don't divide it on the face value, divide on the price, which is this 97. It's not the 100. Because of that, the yield will always be higher. You can see that because you're dividing on a smaller number, like this. But you still use the 360. So it divides the price you actually pay, what you actually invested, but it still uses this 360 days in a year. And it will always be higher because of the denominator is lower, right? Or smaller, I should say, as you can see here. Then you can also do a bond equivalent yield, where you take the same thing that you did above here for the investment yield, but in this case, what they use is they use 365 days. So that's the only difference, is this 365 versus this 360. So because it's a higher day count, you know, the bond equivalent yield will be higher than it is here. That's just to illustrate the differences, because it can get very confusing when what are they talking about here? What is it talking about here? And so this, just refer back to this in case you're confused. You can try it out here in DuckDB. Just copy this guy here and then open up DuckDB. So we'll go and get a command prompt. We'll do a DuckDB unsigned like this. Now I need to get my load function from this folder. So now I'm ready to go. So now I can just copy this guy and put it right into here and run it. And as you can see, here is the same numbers as you saw above in the illustration. Okay, so here, therefore, you can say as a practical rule, the dealer quotes you a price, meaning they give you the discount rate. This is what you see on Bloomberg, Bloomberg information, for example. They are quoting you the discount rate. Anyways, I just want to point that out. It gets a little confusing. Okay, before we just move on, just look at this for a second. The dealer will quote you a price. They'll give you the discount rate, that first one you saw up there. Then you want to know what's your actual return going to be. Well, you use the investment yield calculation where you divide on the market price that you can actually pay, remember, and not the face value. And then you want to compare it to other bond or notes or bill instruments. So if you want to compare to, let's say, a treasury note, you need to convert it to this bond equivalent yield that we looked at here, this one. If you want to price from a quoted rate, you use this one, okay, using the discount rate. And if you want to find the rate from the price, you use this function, the yield discounted. So just a little bit information there for these functions. All right, so here's another example, corporate commercial paper that matures in 182 days because it was, remember, it's a leap year. And it has 5.5% discount rate and $100 redemption value. So you want to calculate the price in this case because you're given the yield, which you saw from above was 5.5. So how do you do that? Well, you use this price discounted function. First, you find the date diff like this, and then you are putting in the actual yield here, and then you calculate the price, which will be this one right here. All right, so that's just another example. You can also work out the arithmetic of this running this query in DuckDB CLI or, the UI, depending on what you want to do. If you buy $1 million worth of this, you can scale it. So you can follow this query. And here is a yield of a discounted security function. This one right here. It's pretty straightforward. You're putting in the price here. You base it on 100 in this case. And you use the number 2. So that will compute the actual yield, the discounted yield. And then you can do your round trip here. You can also calculate the discount rate of a security. So what does that do? Well, it calculates the discount rate of a security if you give the settlement price and the redemption value. You can see it here. If you have a treasury bill that you buy for $98.50, that's going to mature. Again, it's going to be 100 worth when you actually get your money back. 90 days. Now, this might not be right. April 1st to July 1st. I would have to run that diff function to see if that is actually correct. If you look here, I run the date diff, this one, on those 2 dates, and you can see it's actually 91. It's not 90, as you can see here. So this should actually be fixed. Okay, so it produced, actually it's 5.9. It's not exactly 6. Okay, so slightly different. Okay, so again, you got to be careful with the actual number of days here. So I'll probably have to update this example here. All right, you can also compare the disk and the yield disk for the same security. So here we got 5.9 versus 6.02, as you can see, which is the investment yield, this one. And then the discount rate is this. So that's a little bit about that. The second group, as you can see here, dealing with bonds that pay all interest as a lump sum at maturity rather than periodic coupons. So in other words, they pay the interest at the very end instead of regularly in between, like every 6 months, what have you. So this is common in corporate notes and some of the government securities. So it's not a zero coupon bond because that has no interest rate, okay? But this one, they have a stated rate or a coupon rate, if you will. So that's the difference there. And you can use this one. I'm not going to dwell on this because I'll let you read through it yourself. But you can see here you got a 1-year corporate note issued on January 1st, 2028, and it matures at January 1st, 2029. And the coupon rate is 5%. The investor requires 6% yield. So you put the 5% coupon here and the yield in here, and then you use price maturity function. So let's see what this turns out to be. So let's just run that. And we'll paste it anyway. And as you can see, it produced 99.0566 in the value. Okay, so that's because you're given the yields. So you're solving for the price to maturity here. And you can go through here to verify, just like you do in math problems. Then you have a yield to maturity. So all of these are kind of offset because one is solving for the price, one is solving for the yield because you know the price like this. And therefore you can just run it for the yield to maturity. So again, keep in mind the reason you put that in is because you know there's a coupon rate. It's not a zero coupon bond. So you can run that one as well. So let's just, for completeness, just like run this guy and paste. And as you can see here, it produces this yield to maturity because you know the coupon rate and you know the price that they charge for it. So you can compute the actual yield to maturity like this. So there's more examples like this. I notice I'm running into 20 minutes already. Put this out on my GitHub repository. There is a group 3, which is fully invested securities. So for example, certificates of deposits and some short-term notes works this way. And again, there's some example here. For example, you invest $95,000 in a 9-month corporate CD or certificate of deposit, and you do it on January 1st, 2028, and it matures on October 1st, 2028. What happens then is you're going to receive $100,000 right then. So you're paying 95, you're going to get 100. So what kind of interest rate did you earn? You can use this function right here to figure that out. And again, it requires you putting in a settlement date, a maturity date, the investment amount, which is, of course, this. Redemption amount is what you're going to get at the very end when it matures. And then your basis is 1. I think 1 is actual, if I remember right. And then you have this received function, which is how much are you going to receive at maturity. So it's the inverse of the int rate. And you can calculate the actual amount received at maturity. And that function works like this. Put in the settlement, the maturity date, the investment amount, the amount of discount, and the basis. So here you can see, here's the price. Here is the discount rate, as you can see here. It takes the discount rate, not the investment yield. And then you run it, and then you can run this verification right here. So let's see what this one produces. So you put it into the, let me make it a little easier to read here. Paste that in like this. And you can see here it produced 99,859. So it's almost 100, but not quite, as you can see here. And there's some other examples here you can look at. And the final group is the accrued interest. So when you buy a bond between coupon days, it's already been issued. So you're going to buy it between the coupon rates. So what happens then? Well, you owe the seller the interest that has accrued since the last coupon payment. So you're going to have to pay that. And then you start getting your coupon payments on the regular dates. So even though you receive the full coupon on the next, you have to pay the difference up front. So this accrued interest, you have to add to this clean price, as it's called. And therefore, it will produce a dirty price, what you're actually going to have to pay. So there are two functions here, this one and this one. So the first one, you pay periodic coupons, like you do on corporate bonds. I mean, you do it on bonds that pays periodic, I should say. And then it is on bonds that pay interest only at maturity, like a zero coupon style. So there's a couple of examples here. I'm going to let you just look at it yourself if you're interested. And there's also some journal entries you can use to see how this will happen if you care about accounting. And then it finishes down here with a couple of more examples. And then you can have a complete function reference like down here, where you can actually look at all the different functions in one place. And here's just a summary of what these different functions are doing and what group they are falling under. So that's the end of this documentation, and hopefully at least you have some idea of what these formulas can do and what they cover, because it can be very confusing just to look at the names and try to figure it out from there. So hopefully this helps you a little bit. And if you're going to be doing these kind of calculations, you can use my community extension. And again, I've been through this so many times. You can just watch one of the previous videos to figure out how you can get that and use it in DuckDB. Hope you like this video. If you do, give me a like and consider subscribing to my channel. It'd be fantastic. I look forward to see you in the next video. Take care, everybody.